In this video, we're going to try and go through how to post a payroll journal to your accounting system. The accounting system we're using is Zoho Books. And we're also talking about this from a United Kingdom perspective. However, a lot of the concepts around payroll, withholding tax, etc. is very, very similar in most countries. So what is a payroll journal and what's the purpose of it? Payroll journal is the process of recording a transaction in your accounting system that reflects all the individual transactions, whether it be a cost or a liability, that get created as a result of paying your employees. There is other ways to do this, potentially without running journals, etc. But the most accurate and robust way to do this is to follow the following process. Download or prepare a payroll journal from your payroll software. Most payroll software should produce a payroll journal. If they don't, you're actually going to have to create a payroll journal from other payroll reports that detail employees' gross pay, PAYE, national insurance, etc. And then upload to the accounting system. After you've posted that, you're then going to have to go back to the bank reconciliation process and make sure that the liabilities that you create via the payroll journal have been offset by the associated banking transactions. Okay, so a payroll journal is a list of debits and credits, like everything in accounting. You're going to manually post these debits and credits to the accounting system. Some of them are going to be impacting the profit and loss statement or profit and loss account. And then the other side is going to be impacting the balance sheet or statement of financial position. For the profit and loss items, on a UK payroll, you tend to have total gross pay that would be anything like all your cash remuneration paid to the employees, allowances, holiday pay, etc. In the UK, we've got mandatory pension legislations. It's called automatic enrolment. So there's almost always going to be a payroll item to enter here. And there's always an employer pension item to consider, which obviously impacts the cost of the business. And then we've got social security. In the UK, we call social security national insurance. And there's an employer's aspect and an employee's aspect of national insurance. So on the profit and loss account, these are the main items that show the cost of running the payroll. What you're trying to work out by posting these items is the total cost of employment for a business. So the employer's national insurance and the employer's pension is a cost to the business, and it's on top of the total gross pay. So it needs to be reflected on the profit and loss account when you're working out your profit and loss, basically. There could be other items hitting the P&L, and it can get obviously a lot more complex. On the balance sheet or statement of financial position, the other accounts that's kind of hitting this is PAYE payable. So in the UK, we call it pay as you earn tax, where the employer has to take tax off the employee before they pay them their wages. And that's obviously recorded separately in a payroll journal normally, but it can be combined with the next line, which is national insurance payable. The important thing to note with national insurance payable is there's an employer's element as well as an employee's element. So when you're recording it on the balance sheet, as opposed to the P&L, you'll notice that we had national insurance sitting there, but it was employers' national insurance specifically. On the balance sheet, you're looking at employers' and employees' national insurance, because this is the combined total. With the PAYE payable and national insurance, what's the purpose of this is these tend to be, but not always, they tend to be credit entries, and credits increase liabilities. So what you're trying to do by posting these two items is you're trying to record your liability that is payable to HMRC, which is Her Majesty's Revenue and Customs in the UK. But this could be any other tax authority, and the principles tend to work the same when you're recording the journal. So let's say I have my gross pay, I've deducted my national insurance and I've deducted my PAYE. The final bit is obviously I've got to pay over my net wages to the employee. These net wages need to be recorded as a liability, and obviously as the payments go out the bank account to the employee, all those payments, we'll show you later, kind of get reconciled One more account is pension payable. Like the national insurance, there's an employee and employers element to this. So the pension payable account is kind of aggregating the two elements. This amount would be getting paid to the workplace pension scheme. The three parties that are getting paid usually through payroll is going to be the employees via their net pay, HMRC for the PAYE and national insurance, and then the pension scheme for the pension. Obviously, more complex payrolls will have more liabilities to pay. For example, in the UK, you have concepts like attachment of earnings, where a court might order a judgment on an employee to have something deducted from their wages. We also have concepts of childcare vouchers. And if you have all these things, these would be recorded on the balance sheet, and the liabilities payable to those third parties would kind of be recorded during that process.